9:30 a.m. Eastern Time. The silver market froze. Not a glitch, not maintenance, a complete shutdown at $98 per ounce. American screens went dark, while Shanghai kept trading at 110. But here's what they're not telling you. Physical silver is changing hands at $130 right now. The paper price says 98. The real metal says 130. And a major U.S. bank has 72 hours before the mathematics of this gap become impossible to hide. Welcome to your John A.G. Now, if you've been in the game long enough to remember when markets actually functioned the way they promised, when the price on your screen meant something real, when handshakes and contracts were honored, then you understand why that subscribe button isn't just a formality. It's your seat at the table where the real conversation happens. Hit subscribe, because what unfolds in the next few minutes changes how you'll need to think about every asset you hold. And drop a comment below. Tell me where you're watching this from. New York, London, Mumbai, São Paulo. Because geography just became critical. The game is no longer global, it's local. Let's begin. At exactly 9:30 in the morning, Eastern Standard Time, something unusual happened in the silver market. The price reached $98 per ounce, and then the system stopped accepting orders. Traders in New York stared at their screens. The numbers were frozen. No new trades were processing. The Chicago Mercantile Exchange had executed what they call a circuit breaker halt. But this was not a normal pause. The exchange claims circuit breakers exist to prevent panic. When prices move too fast, the system pauses trading. It gives everyone time to think, time to reassess their positions. The official explanation uses terms like orderly markets and price discovery. The reality tells a different story. When silver hit $98, the exchange did not halt trading because the price was moving too fast. They halted it because the price was moving too accurately. The market was trying to find its real level, and that level was higher than the system could afford to show. Here is what most business owners do not understand about futures markets. These markets were not designed to actually deliver physical metal. They were designed to settle in cash. Out of every 100 silver contracts traded on the exchange, fewer than 3 result in actual delivery of silver bars. The rest close out before expiration. Traders take their profit or loss in dollars. The metal never moves from the warehouse. The system works perfectly until it does not. On this particular morning, something unusual was happening. Buyers were demanding delivery, not just a few speculators trying to make a statement. Large institutional buyers were standing for delivery. Industrial users who actually need physical silver for manufacturing were requesting the metal. And there was not enough to give them. The exchange operates on what banking professionals call a fractional reserve system. For every 100 ounces of silver that trade on paper, only a fraction exists in physical form in the registered warehouses. When everyone is trading for cash settlement, this creates no problem. But when buyers start demanding the actual metal, the mathematics break down. While American exchanges went dark, something revealing was happening across the Pacific Ocean. The Shanghai Futures Exchange kept trading. Their price was showing $110 per ounce. The same metal, the same moment in time, but a $12 difference between what Americans could see and what Chinese traders were paying. Then reports started coming in from the physical dealers, the businesses that actually buy and sell silver bars. They were quoting $130 per ounce for immediate delivery, 3 different prices for the same asset. 98 on the frozen American exchange, 110 in Shanghai, 130 for physical metal in hand. This is not how functional markets behave. A circuit breaker is supposed to be temporary, a cooling off period. But as the morning progressed, the halt remained in place. No announcement about when trading would resume, no explanation beyond the standard regulatory language. Traders began making calls. Risk managers started running calculations. Treasury departments and companies that use silver for manufacturing began scenario planning. Because everyone who understood the mechanics of what was happening realized the same thing. When this market reopens, someone will have to absorb the difference between 98 and reality. The question was not whether the price would adjust upward when trading resumed. The question was how many institutions would survive that adjustment. Silver is not just a precious metal that investors buy. It is an industrial commodity. Electronics manufacturers need it. Solar panel production requires it. Medical device companies use it. These are not speculators. These are businesses with production schedules and supply chain commitments. When the market that is supposed to provide price discovery and supply access simply stops functioning, those businesses face a calculation they never planned for. Pay whatever the physical market demands, or shut down production lines. The halt was not protection for market participants. It was protection for the market makers themselves. And as morning turned to afternoon with the halt still in place, a single question began circulating through trading desks and corporate boardrooms around the world. What happens when the mathematics of a fractional system meet the physics of actual demand? The answer to that question was about to become very expensive for someone. A commodities trader in Chicago made a phone call at 10:15 that morning. He wanted to take delivery of his silver contracts. The voice on the other end went quiet for 7 seconds. Then came the question he was not expecting. How soon do you need it? That pause, those 7 seconds of silence, contained an entire revelation about how modern markets actually function. The trader held contracts representing 50,000 ounces of silver, legal documents that gave him the right to demand physical delivery. The exchange rules were clear. He had followed every protocol. His margin account was funded. His delivery instructions were filed. But the person on the other end of that phone call had a problem. The silver he was asking for was not there, not in the way he thought. To understand what happened that morning, one must understand how commodity futures markets were built. These markets began as something useful. Farmers needed to lock in prices before harvest. Manufacturers needed to secure supply costs months in advance. The futures market gave them both a tool. A farmer could sell wheat futures in spring, guaranteeing a price for his autumn harvest. A baker could buy wheat futures in spring, guaranteeing his cost for autumn production. When autumn arrived, they would settle the contract. The farmer delivered wheat. The baker took delivery. The futures market had served its purpose, but markets evolve. Financial institutions noticed something. Most contracts never resulted in actual delivery. Traders would buy contracts, then sell them before expiration. They were not interested in the wheat. They were interested in the price movement. This created an opportunity. If most contracts settle in cash instead of physical delivery, the exchange does not need to have all the physical commodity available. They only need enough for the small percentage who actually take delivery. For decades, this worked. In the silver market, the mathematics looked like this. For every 100 ounces of silver traded in futures contracts, the exchange maintained approximately 4 ounces in physical form in their registered warehouses, a 4% reserve. 96% of the trading was pure speculation, price bets, paper moving back and forth, no actual metal changing hands. This created enormous leverage in the system. A bank could sell contracts representing 10 million ounces of silver, while holding only 400,000 ounces in physical inventory. As long as everyone settled in cash, the mathematics never got tested. The profit potential was substantial. Banks would sell silver contracts when prices rose. They would buy them back when prices fell. The difference was pure profit. And because they were dealing in paper contracts rather than physical metal, they could scale these trades to enormous sizes. But leverage works in both directions. On that particular morning, something shifted. Industrial buyers stopped playing the paper game. They wanted the actual metal. Manufacturing plants in Asia were placing orders. Solar panel producers needed supply. Electronics companies had production schedules to meet. They were not speculating on price movements. They needed silver bars in their warehouses. When one buyer demands delivery from a fractional system, the bank can handle it. They pull metal from the registered warehouse, problem solved. When 10 buyers demand delivery, the bank starts making phone calls. When 100 buyers demand delivery simultaneously, the mathematics become impossible. Margin requirements add another layer to this mechanism. When someone buys a silver futures contract, they do not pay the full value up front. They post margin, a fraction of the total contract value. At $98 per ounce, a standard 5,000-ounce silver contract represents $490,000 of value. The margin requirement? Approximately $30,000. The 16-to-1 leverage magnifies every price movement. When silver rises $5, the margin account gains $25,000. When silver rises $10, the margin account gains $50,000. But when institutions are on the wrong side of that trade, when banks have sold contracts they cannot deliver against, the mathematics reverse. A $10 rise in silver price becomes a $50,000 loss per contract. Multiply that across thousands of contracts, and the numbers become catastrophic very quickly. That phone call at 10:15, that 7-second pause, that was the sound of someone calculating whether the metal existed to fulfill the request, and realizing it did not. A risk manager at a European bank opened a spreadsheet at 11:42 that morning. The file was marked Silver Derivative Exposure, Confidential. He scrolled to the bottom row. The number showed negative $843 million. He refreshed the calculation. The number grew larger, negative $912 million. He had not changed any inputs. The only variable that moved was the silver price, and silver was still halted at $98. But the system was calculating based on where physical silver was actually trading, $130 per ounce. That $32 difference, multiplied across the bank's entire short position, had just created a problem that did not exist an hour earlier. And he knew something else. His bank was not alone. The concentration of silver short positions among major financial institutions is not a secret. Regulatory filings reveal it. The Commodity Futures Trading Commission publishes reports showing which category of traders holds which positions. What those reports do not show is the names. They categorize traders as commercial or non-commercial. They show aggregate positions. But they do not identify that 3 banks hold 68% of the commercial short interest in silver. 3 institutions, 68% of all short bets. When the market functioned normally, this concentration created no problem. These banks made markets. They provided liquidity. They took the other side of trades, and their deep pockets and sophisticated risk models allowed them to manage large positions. But sophisticated risk models have a weakness. They are built on historical data. And history had never seen industrial buyers demanding physical delivery in this volume. While paper prices were disconnected from physical prices by $32, while exchanges were halted, all at the same time. The models were not designed for this scenario. Mark-to-market accounting rules create an interesting dynamic. Banks must value their positions based on current market prices at the end of each day. When they hold short positions and prices rise, they must recognize those losses immediately, even if they have not closed the position yet, even if they believe prices will eventually fall. The accounting rules do not care about their beliefs. They care about today's price. At $98, these banks had manageable losses on their books. Uncomfortable, perhaps, but manageable. At $130 for physical metal, the mathematics changed entirely. But the real vulnerability was not in the futures market. It was in the over-the-counter derivatives. Most people focus on the exchange-traded futures. Those contracts are standardized, regulated, cleared through central counterparties. When something goes wrong, the clearinghouse steps in. The over-the-counter market operates differently. Banks make private deals with other banks. Custom contracts, negotiated terms, no exchange involved, no central clearing, just 2 parties and a legal agreement. The OTC silver derivatives market is estimated at 14 times larger than the exchange-traded market. 14 times. And it is invisible to everyone except the 2 parties involved in each contract. When one bank has a large silver position with another bank, and prices move against them, that creates a direct link between the 2 institutions. If Bank A cannot meet its obligations to Bank B suddenly has a problem it did not expect. And if Bank B had assumed that payment from Bank A when it made commitments to Bank C, the problem spreads. This is what financial analysts call counterparty risk contagion. The failure of one institution does not stay contained. It ripples through every contract, every commitment, every assumed payment that other institutions had built into their own risk calculations. In 1998, a hedge fund called Long-Term Capital Management collapsed. The fund was not particularly large, $4 billion under management, not enough to threaten the global financial system. But LTCM had derivative contracts with every major bank on Wall Street. When LTCM failed, those contracts created losses at 12 different institutions simultaneously. The Federal Reserve had to organize a bailout, not to save LTCM, but to prevent the cascade of failures that would follow if those derivative contracts went into default. On the silver market at $98, with physical trading at $130, with banks holding concentrated short positions, with OTC derivatives 14 times larger than the visible market. The structure looked familiar to anyone who studied LTCM. Concentrated bets, invisible leverage, interconnected exposure, and a price movement that the model said was impossible. Regulators were supposed to prevent this type of concentration. The Commodity Futures Trading Commission has authority to set position limits, maximum sizes for any single trader, but that authority has been debated for 14 years, delayed, challenged, never fully implemented. The banks argued that position limits would reduce liquidity, that their large positions were necessary for market functioning, that their risk models were sophisticated enough to manage the exposure. And while that debate continued, the positions grew larger. That risk manager in Europe closed his spreadsheet at 12:03. He picked up his phone. The call he was about to make would travel through 6 time zones to reach a counterparty who had just opened their own spreadsheet and found the exact same problem. A manufacturing executive in Tokyo received an email at 2:17 in the afternoon. Subject line, silver supply, immediate action required. His company produced solar panels. Each panel required approximately 20 grams of silver. His factory produced 12,000 panels per day. That meant 240 kilograms of silver every single day. His procurement contract guaranteed delivery at $94 per ounce. The email informed him that his supplier could no longer honor that price. New price, $135 per ounce. Take it or find another supplier. He opened his calculator. The price increase represented an additional $984,000 per day in raw material costs. Per day. His profit margin on 12,000 solar panels was $1,200,000. The silver price increase had just consumed 82% of his daily profit. He had 3 choices. Shut down production until prices stabilized. Accept the new price and operate at minimal profit. or raise his prices and hope his customers would accept the increase. None of these choices existed yesterday. This is what happens when paper markets disconnect from physical reality. The businesses that actually use these materials, the companies that build things, manufacture products, fulfill contracts, they operate in the physical world. They cannot trade paper promises. They need actual metal. And when the pricing mechanism breaks down, when exchanges halt, when paper says 98 but physical costs 135, these businesses face immediate operational crises. The solar panel executive was not alone. Electronics manufacturers in South Korea faced the same calculation. Silver is essential for circuit boards, for semiconductors, for the devices that power modern technology. Medical device companies in Germany needed silver for antimicrobial coatings, for specialized instruments, for equipment that cannot function without it. Every single one of these businesses had built their financial models on stable silver prices. They had hedged their exposure through futures contracts. They had procurement agreements with suppliers. And in one morning, all of those assumptions required recalculation. Treasury managers across multiple industries began running scenarios. If silver stays at 135, what happens to our quarterly numbers? If it goes higher, at what price do we become unprofitable? Do we have alternative materials we can substitute? How quickly can we reformulate our products? What are our competitors doing? But the implications extended beyond individual companies. The silver market halt was sending a signal, not just about silver, about the reliability of financialized commodity markets in general. If paper silver can disconnect from physical silver by $37, what about copper, aluminum, platinum, lithium? Every commodity that trades on futures exchanges operates on similar mechanics. Fractional reserves, cash settlement, leverage. The same vulnerabilities exist across the entire commodity complex. Smart treasury managers recognized this immediately. They began reviewing their entire commodity exposure, not just silver, everything. Where do we have price risk? Which commodities are essential to our operations? Can we secure physical supply agreements directly with producers? Should we hold physical inventory instead of relying on just-in-time delivery? These questions represent a fundamental shift in corporate strategy. For 3 decades, businesses had moved toward minimal inventory, just-in-time manufacturing, financial hedging instead of physical stockpiles. The assumption was that markets would always function, that commodities would always be available at quoted prices. That assumption was being tested. Some companies began exploring direct relationships with mining companies, bypassing the exchanges entirely, negotiating long-term supply contracts with physical delivery terms. Others started building physical inventory, warehouses filled with materials they previously ordered week by week. The geography of commodity sourcing suddenly mattered in new ways. Shanghai kept trading while New York was halted. That was not a coincidence. It was a statement about where physical commodities actually exist and where paper claims exist. Businesses with supply chains running through Asian physical markets had options. Companies dependent on Western paper markets were discovering their vulnerability. The multipolar commodity trading environment was no longer theoretical. It was operational reality. The halt revealed something that sophisticated business leaders already suspected. The financialization of commodity markets had created a layer of abstraction between actual supply and quoted prices. That abstraction worked perfectly until it did not. And when it failed, the businesses operating in physical reality paid the price for the paper market's mathematics. The solar panel executive in Tokyo made his decision at 3:44 that afternoon. He accepted the $135 price. He had production commitments, customer contracts, employees depending on continued operations. He could not wait for the paper market to resolve its problems. He needed silver, real silver, and he would pay whatever the physical market demanded. That decision, multiplied across thousands of businesses, in dozens of industries, across multiple continents, was creating a new price floor, not on paper, in reality.